Welcome to Morris Money, where we talk about some of the most interesting small cap stocks in under 5 minutes. I'm your host, Morris Money. Today, I'm talking about why Hanesbrands could be undervalued and why it has some upside potential coming in 2024. Hanesbrands has suffered significant losses over the past several years, with its share price falling over 80% from all-time highs of $33.70 in June 2015 to around $4 current day. Recently, activist fund manager Barrington Capital Group recognized the company's potential for improvement. They sent a letter to Hanesbrands chairman Ronald L. Nelson urging immediate and decisive actions. Indeed, the company appears to be considerably undervalued, presenting numerous opportunities to enhance shareholder value. Let's start at number 1. The company is an innerwear and activewear apparel leader. The company is a prominent manufacturer in the basic innerwear and activewear apparel market, boasting notable brands such as Hanes, Champion, Maidenform, Ross & Things, and Wonder Bra. In 2022, Hanesbrands generated approximately 69% of its net sales in the United States, with Walmart being its largest customer, contributing 16% to sales. The U.S. consumer directed channel, which includes e-commerce websites, accounted for about 17% of the total sales in the same year. Regarding business segments, innerwear emerged as the top revenue generator in 2022, bringing in $2.4 billion in sales and comprising 39% of total sales. Do you want to be featured on Morris Money? Be sure to subscribe or leave a comment down below and you could be featured on the Morris Money ticker. Now, back to the video. The international segment followed closely, recording $1.9 billion in sales, or 30.7% of overall income. The activewear segment ranked third, contributing $1.6 billion in sales, nearly 25% of total revenue. Next, let's look at gross margin and operating margin trends. From 2012 to 2018, Hanesbrands experienced an upward trend in its gross margin, climbing from 31.3% to 39%. However, there was a decline to 35.6% by 2022, further dipping to 32.7% in the first quarter of 2023. This decline can be attributed to mainly the rising cost of cotton, the company's primary raw material. Cotton prices escalated dramatically from 50 cents per pound in March 2020 to nearly $1.55 per pound in April 2021 due to the COVID-19 pandemic, resulting in higher costs of goods and a reduced gross margin. Fortunately, in the final quarter of 2022, cotton prices and freight rates became declining. Since then, cotton prices have stabilized between 76 cents and 90 cents per pound. In the second quarter earnings call, Hanesbrands management noted a substantial decrease in cotton costs by nearly 40% year over year and an 80% reduction in ocean freight costs. These improvements were reflected in the gross margin. Which increased 35.5% in the third quarter. Given these trends, higher enhancement in gross margin is anticipated in the next several quarters. Concurrently, the company's operating margin has been decreasing. After peaking at 13.2% in 2019, it gradually fell to 8.3% in 2022. A major contributor to this decline is a significant increase in selling, general, and administrative expenses, which rose nearly 87% from $911 million in 2012 to over $1.7 billion in 2022. These expenses, which were within management's control, suggest potential for improved operational efficiency and cost reduction. In its letter to the company, Barrington Capital said it expects the company to cut selling, general, and administrative expenses by a minimum of $300 million annually and allocate the savings towards reducing its debt. Final topic I'm going to cover in this video is their high leverage and staggered debt maturities. Hanesbrands has been operating with a substantial amount of leverage. As of the third quarter of 2023, the company reported a modest $274 million in shareholder equity compared to a hefty $3.31 billion in long-term debt, with an additional $59 million in debt due within the next year. This has resulted in a record high debt to equity ratio of 10.8. However, two positive indicators offer some reassurance. First, the interest coverage ratio was a manageable 3.3 times in 2022. Second, the debt maturities are spread out until 2031, with only $200 million due in May 2024 and $900 million due in May 2026. This staggered schedule allows Hanesbrands to reduce costs and invest those savings to lower its debt levels over time. Despite its recent challenges and operational inefficiencies, Hanesbrands shows potential for a promising turnaround. The company's strong brand portfolio, decreasing costs, and strategic steps towards cost optimization indicate improving profitability. Additionally, its current significant undervaluation in the market presents an attractive investment opportunity for those willing to bet on its potential recovery and long-term growth. Currently, Hanesbrands has about 10 analysts covering the stock, one giving it a strong buy, 7 giving it a hold, 1 giving it a sell, and 1 even giving it a strong sell, but it is undervalued. Currently, it has a price target of $5.67 with a potential 27% upside from this point. Let me know your thoughts about Hanesbrands down below, and let me know about any undervalued stocks you're buying in 2024. Thank you for watching Morris Money.